Listen carefully, because what I'm about to say is not noise, it's a warning. While headlines kept you distracted with interest rates and elections, a quieter, more strategic move was unfolding. China didn't fire a missile. China didn't announce a war. China did something far more powerful. It weaponized silver. And in that silence, America didn't just lose leverage. It lost an estimated $420 billion in strategic value. This is not a conspiracy. This is economics, power, and preparation colliding in real time. China's approach to silver reveals a fundamental difference in how economic power is understood and exercised. While much of the world continued to treat silver as a secondary commodity, useful but replaceable, China recognized it as a strategic asset embedded at the core of modern civilization. This distinction matters because commodities are traded for profit, but strategic assets are secured for control. The moment silver was reclassified in China's long-term planning, it stopped being just metal and started becoming leverage. What makes silver uniquely powerful is its dual nature. It is both a monetary metal and an industrial necessity. You can speculate on it, but you cannot substitute it easily. Every solar panel, every electric vehicle circuit, every advanced semiconductor, and every modern weapon system depends on silver's unmatched conductivity. The hook most analysts overlook is this: the future economy is not digital alone, it is physical, and silver sits at the intersection of energy, technology, and security. China acted on this understanding with patience rather than urgency. Instead of chasing price spikes, it focused on accumulation. State-backed entities secured long-term mining contracts, increased imports during periods of suppressed pricing, and quietly expanded refining capacity. This was not accidental behavior, it was deliberate positioning. When markets undervalued silver, China saw opportunity, not weakness. When others saw volatility, China saw discounted strategic insurance. Another critical layer of the strategy was separation from short-term market sentiment. China did not rely on paper derivatives or speculative instruments to define silver's value. It prioritized physical ownership and supply certainty. That choice alone insulated it from price manipulation and future scarcity. The real hook here is uncomfortable but true. Ownership of physical resources outlasts any financial model built on leverage. By treating silver as infrastructure rather than inventory, China aligned national policy with industrial demand. Energy policy, manufacturing growth, and defense modernization were all synchronized around material availability. This integration reduced vulnerability and increased resilience. In contrast, economies that treat silver as just another trade exposure risk discovering its true value only when access becomes restricted and costs explode. Strategic assets do not announce themselves, they reveal their importance only when they are missing. China understood this early. Silver was never about speculation. It was about ensuring that when the next phase of global development accelerates, China is not asking for supply, permission, or pricing. It already holds the metal that makes progress possible. Control over supply chains has always been the quiet engine of economic power, and silver is a textbook example of how this control translates directly into pricing authority. Markets often focus on demand curves and consumption forecasts, but the real leverage lies upstream at the point where raw material availability is decided. China understood that whoever controls the flow of silver doesn't need to announce dominance. It simply emerges through pricing behavior and market dependency. Silver is not produced evenly across the world, and refining capacity is even more concentrated. By investing heavily in mining partnerships, overseas resource projects, and domestic refining infrastructure, China positioned itself at multiple choke points of the silver supply chain. This matters because price is not set by theory, it is set by availability. When supply becomes constrained, pricing power shifts instantly to those who can deliver, not those who can bid the highest. Here's the hook most people miss. Price power doesn't require hoarding or manipulation. It requires reliability. When manufacturers know one country can supply silver consistently while others face delays, regulatory friction, or shortages, contracts naturally flow in that direction. Over time, this reliability becomes embedded in global trade relationships, locking in long-term dependence that no tariff or policy can easily unwind. China also leveraged timing. It expanded its supply control during periods when silver prices were artificially suppressed in global markets, while others reduced investment due to low margins. China absorbed capacity, upgraded refining technology, and secured future output at discounted costs. This countercyclical behavior turned market weakness into strategic strength. When prices eventually respond to real-world scarcity, the advantage compounds. Another overlooked factor is elasticity. Silver demand, especially for industrial and defense applications, is relatively inelastic, so you cannot simply reduce usage when prices rise without slowing production or innovation. That gives suppliers disproportionate influence. When one nation dominates processing and delivery, Even small supply disruptions can send prices sharply higher, transferring wealth and leverage without a single policy announcement. This is where America's vulnerability becomes visible. A market-driven system that assumes global liquidity and free flow struggles when confronted with concentrated supply control. When production, refining, and logistics align under a single strategic vision, market theory gives way to economic reality. The hook is simple but unsettling. The country that controls supply doesn't chase price, it defines it over time. This dynamic reshapes global pricing structures. Futures markets react, manufacturers adjust costs, and consumers absorb inflationary pressure, all while the source of control remains largely invisible. Supply chain dominance turns silver from a traded metal into a strategic lever, quietly shifting economic gravity toward those who plan for scarcity, while others plan for efficiency. America's treatment of silver as a purely financial instrument created a structural weakness that only becomes visible in hindsight when an asset is dominated by paper contracts rather than physical ownership. Its price stops reflecting reality and starts reflecting leverage. Silver markets became heavily shaped by futures, options, and short positions, allowing large financial institutions to suppress price signals without ever needing to secure the underlying metal. On paper, everything looked liquid. In reality, the foundation was thinning. Here's a hook most people overlook. You can short confidence, but you cannot short physics. Silver does not multiply because a contract exists. It must be mined, refined, transported, and delivered. By allowing paper claims to vastly exceed physical supply, the US market created an illusion of abundance. That illusion discouraged long-term investment in domestic mining and refining because low prices told producers their product wasn't strategically important. Capital followed signals, and the signals were distorted. As short positions expanded, price discovery broke down. Instead of reflecting rising industrial demand, silver prices stayed artificially compressed. This had cascading effects. Mining projects were delayed or cancelled. The surge in industrial demand for silver was not sudden. It was predictable, measurable, and publicly visible long before it became critical. What separated outcomes was not access to information, but the ability to translate that information into policy. The silver sits at the core of modern infrastructure. And as the global economy pivoted toward clean energy, electrification, and advanced computing, its importance multiplied. The hook is simple. The future was signaling its needs clearly, but not everyone was listening. China treated industrial demand as a strategic forecast rather than a market fluctuation. Government planning aligned energy targets, manufacturing expansion, and material security into a single framework. Silver deployment alone required massive quantities of silver, and China scaled production knowing that. Every additional gigawatt of capacity locked in long-term metal consumption. Electric vehicles, battery management systems, and high-density electronics followed the same pattern. Demand was not theoretical, it was engineered. In contrast, American policy planning lagged behind industrial reality. Silver demand was largely left to market forces. With limited strategic oversight, clean energy goals expanded. But material inputs were assumed to remain available through global markets. This assumption ignored a basic constraint. Industrial metals are not infinitely elastic. You cannot accelerate adoption without accelerating supply, and supply takes years to develop. This mismatch created a structural vulnerability that only becomes visible once growth accelerates. Here's the hook most professionals underestimate. When demand is policy-driven, supply must be policy-aware. China understood that state-backed demand would eventually collide with limited global production. By anticipating that collision, it positioned itself ahead of the curve. The US, by comparison, reacted to rising costs rather than planning for them. As demand intensified, prices rose, procurement tightened, and strategic industries faced higher input risks. Defense systems added another layer of pressure. Advanced weapons, communications, and surveillance technologies rely on silver's conductivity and reliability. These applications do not allow substitution or delay. When industrial and military demand converge on the same material, competition intensifies. China recognized this convergence early and integrated defense needs into broader industrial planning, reducing exposure to future shortages. The deeper issue is not a lack of innovation, but a lack of coordination. America excelled at technological advancement but underestimated the material foundations that support it. The hook is uncomfortable but necessary. Innovation without resource security creates dependency. When supply chains tighten, technological leadership alone cannot compensate. As industrial demand outpaced policy preparation, the imbalance widened. Costs rose, timelines stretched, and reliance on external supplies increased. What appeared to be a smooth energy transition revealed itself as a material race, one where preparation determined resilience and delay translated into strategic disadvantage. The figure of $420 billion is often misunderstood because it sounds like a single loss event, when in reality it represents something far more complex and far more damaging. It is the cumulative cost of mispositioning, lost leverage, and delayed recognition of silver's strategic role in the global economy. The real hook is this: nations rarely lose power through one bad decision. They lose it through a long series of reasonable choices that ignore long-term consequences. This loss reflects the gap between what silver was priced at and what it was actually worth in strategic terms. For years, suppressed prices signaled abundance and low importance, encouraging underinvestment and complacency. While the market focused on short-term efficiency, the strategic value of securing future supply was quietly compounding elsewhere. When demand accelerated and supply tightened, that hidden gap surfaced as higher costs, weaker bargaining power, and reduced control over critical industries. Another layer of this loss is leverage erosion. When a country controls strategic materials, it gains optionality, the ability to influence prices, negotiate trade terms, and shield key sectors from shocks. When it doesn't, it pays premiums instead. The $420 billion figure captures this asymmetry. It reflects higher import costs, reduced competitiveness in manufacturing, and vulnerability to external supply decisions. The hook most analysts miss is that leverage, once lost, is far more expensive to regain than it was to maintain. This missed value also shows up in opportunity cost. Capital that could have been deployed into domestic mining, refining, and stockpiling was instead absorbed by financial markets that delivered liquidity but not security. As a result, future investments now require higher spending under less favorable conditions. Developing capacity during scarcity is always more expensive than securing it during surplus, and a cost difference compounds across years and industries. There is also a timing dimension that magnifies the loss. Strategic assets reward early action disproportionately. China's accumulation during periods of low prices translated into lower average costs and higher future influence. America's delayed response means it now competes for the same resources at elevated prices, with fewer suppliers and tighter margins. The hook here is uncomfortable but precise. Timing in resource strategy matters more than scale. Ultimately, the $420 billion estimate represents a transfer of advantage rather than a disappearance of value. That value did not vanish. It shifted. It moved toward those who anticipated scarcity, aligned policy with material reality, and treated silver not as a line item, but as a foundation. What looks like a financial loss is in fact a strategic rebalancing, one that continues to shape costs, dependencies, and influence long after the numbers are calculated. As global debt levels expand and confidence in fiat currencies becomes increasingly fragile, hard assets naturally reclaim their role as anchors of economic stability. This shift is not ideological, it is mathematical. When governments rely on debt to sustain growth and liquidity to manage stress, purchasing power becomes the silent casualty. Silver, unlike currency, does not depend on policy credibility. It exists outside balance sheets, outside promises, and outside political cycles. The hook most people miss is this: when trust weakens, tangibility strengthens. China anticipated this environment long before inflation became a headline issue. It recognized that currency systems, no matter how sophisticated, are ultimately confidence-based. When debt to GDP ratios climb and monetary expansion accelerates, the appeal of assets that cannot be printed intensifies. Silver's value rises not only because of demand, but because it represents certainty in a world of variables. This understanding guided China's accumulation strategy while others debated monetary theory. Another critical hook lies in asymmetry. Fiat systems require constant maintenance, interest rate adjustments, liquidity injections, and policy coordination. Hard assets require none of that. They simply exist. As global markets face currency volatility, trade fragmentation, and geopolitical risk, silver becomes a neutral store of value and a functional input. China positioned itself to benefit from both dimensions: monetary resilience and industrial necessity. In contrast, America placed greater faith in financial instruments and reserve currency status. This worked well in a low-inflation, high-trust environment, but as debt expands and real yields compress, reliance on currency dominance alone becomes less secure. The hook is uncomfortable but real. Reserve status protects purchasing power only as long as confidence holds. When it weakens, hard assets regain influence rapidly. Silver's role in this transition is amplified by its accessibility. Unlike gold, it operates across monetary and industrial domains simultaneously. This dual function allows it to absorb value shifts more efficiently during periods of monetary stress. China recognized that as currencies face pressure, silver would not just appreciate, it would become more strategically relevant. Control over supply in such an environment translates into pricing, influence, and economic insulation. The broader implication is a divergence in economic philosophy. One approach assumes stability and optimizes for efficiency. The other assumes volatility and prepares for resilience. China aligned itself with the latter, using silver as a hedge against systemic risk. America, prioritizing financial innovation and liquidity, underestimated how quickly conditions can change. The hook that ties it all together is simple but powerful. When debt grows faster than confidence, metals grow louder. Silver does not debate policy. It does not respond to speeches. It responds to reality. And in periods where currency risk rises, those who secured hard assets early find themselves insulated from shocks that others are forced to absorb in real time. So here's the real question, not for governments, but for you. Are you paying attention to where real value is moving? Are you building your understanding on headlines or on fundamentals? Because history is clear, those who ignore tangible assets always wake up too late. China didn't weaponize silver overnight. It prepared while others slept. And the lesson is simple, but uncomfortable power favors the prepared, not the loud. Remember this, in every era, wealth changes hands quietly before it changes headlines. Stay alert, stay informed, and never underestimate the metal everyone else told you was irrelevant.